There are 44 fund houses and over 2,500 mutual fund schemes in India, but you can choose and invest in only a few of them. It's not necessary to choose and invest in the funds that has performed very well in the past, but what's most important is to choose the funds which are going to invest, which are going to perform well in the future. So how do you choose and filter the best funds for you? See, the problem with the performance history is that mutual funds do not invest backwards. We cannot just look at a fund's growth and put our money in. We invest forward, and there is much more to analyze than just to see the past returns of a fund. In fact, the best indicators of future performance are the ones that most investors they overlook. In today's video, we'll see 8 factors that are very vital for anyone who wants to invest in a mutual fund. The factors which every investor should look at before he or she puts his money in his investments. And if you're not a finance guy, you hate the investing world, you hate those money jargons, I have a good news for you. You can still invest without the need of all these analysis. Want to know how? I've discussed that in point number 7. So stay tuned. Investing is tricky. Just like I always say, investing is tricky. Every step you take in the financial world is a challenge. With that comes the next big opportunity. This video will give you an insight, but who knows, the next video I post can bring you that next big opportunity. So like this video and subscribe this channel right away, because you never know, in the next video the big opportunity could be waiting for you. You don't want to miss it, do you? So now let's begin. Before I start, the most important disclaimer is anything I show here, any fund I discuss on this video is not a recommendation. I'm not recommending anything to anybody. It is just for an example purpose, because I have not considered your risk appetite, your mentality, your financial state, and your challenges that are coming ahead of you in your life. These factors play a massive role in an investing journey, and I, sitting here, would not know all of these. No matter how things look like, no matter how lucrative things look like, all of these are all just subjective. They all depend on your personal risk preference, your personal preference, and your risk appetite. Always consult a financial expert, do your own research, and then invest. So the first important factor that you need to look at is a fund's performance history. So if you're going to make a historical data analysis for a mutual fund, you need to get it right. The past performance of a mutual fund, definitely it does not guarantee the future performance. It's true, and it is a disclaimer in the mutual fund industry. You just cannot depend on the past performance for future performance. But it does matter when you are actively analyzing a mutual fund. Many of us get caught in this trap of past performance. We fall in this trap of selling off and buying new funds which are performing best. We are consistently chasing the returns in a mutual fund. Many of us do that. You know what you're actually doing if you're doing this? You're actually trying to time the market. This is not investing. Timing the market is not investing. Unlike any other areas, whenever you try to time the market, be it stocks, be it stock trading or whatever it is, evidently you at times buy high and sell low. That's where you end up with. And if you're trying to do the same thing with the mutual funds, you would evidently end up doing the same. This is just the opposite of a wise investing behavior. But if at all you're indicating or at all you're analyzing a fund for its past performance, do it for at least for those funds who have been in the market for more than 5 to 7 years. Because then that will tell us about the stamina, the authenticity, the nerve of the fund manager, the nerve of that person who's managing the fund, how well he has disciplined his approach towards his investment, how well he has diligently allocated the assets for the fund, and how well he has managed to beat the benchmark over and over and over for a very long period of time. 5 years, 7 years. Definitely there has been a crash. Definitely there has been a market correction. How well has he managed during those times? This would give you an indication. Let's take a risky category and choose the list of funds there. We'll take an example of the small cap category and choose from the funds available. So, if I go to value research and search for an equity small cap fund, I get a list of funds with their age. I can simply select the ones that has been around for more than 5 to 7 years and reject the rest, no matter how beautiful they look in terms of returns. So the key is to choose the funds that has been in the market for a very long time and they have given good returns. The reason is simple. The fund that has been on the market for a very long time and has proven its worth is worth giving it a consideration for further analysis. We can pick those funds and keep in the basket for further investigation. That's a green card. Number 2, the fund manager tenure. So if you're just filtering a mutual fund based on the last 5 or 10 years performance, you can make a mistake. See, I told you, you can keep it in the basket for further analysis, but you cannot blindly pick up that fund and put your money in. It could quite well be possible that for the last 10 years, this fund has beaten the benchmark handsomely well. And now, this year, probably last month, probably a couple of months back, the fund manager who was managing this fund, he left. And there is a new fund manager who is in place. There is a new fund manager who is now managing this fund. He is managing this fund for the last 2-3 months, and you pick up the last 10 years returns and put your money in. You would know how this manager would run this fund, would you? The exact opposite can also be true. You simply cannot dismiss a fund because for the last 10 years performance has been bad. Possibly because the fund manager who was managing those last 10 years has not done well with this fund. Now he has moved on, a new fund manager has come in. This manager could well do something new, could absolutely turn the steering wheel around for this fund. Can it happen? Yes, it can. So in summary, be rest assured that the fund that you're trying to manage, the past history for the last 7 or 10 years should coincide with the fund manager's experience, and he should have been with this fund for that long. He's been managing it. If the fund manager experience is less than 3 years, less than 2 years, I would completely ignore that fund, no matter how well the fund has performed. But how to check this information? I've told you what to look for, but where do you look for this? Let me show you how. I'll choose a mutual fund, but this is not a recommendation. Once again, I'll just choose a mutual fund to show you where you can get this data. This mutual fund is not my recommendation. Okay? So we'll go to Grow and type in a mutual fund name. Say I'll choose Nippon India Small Cap Fund. It's just a random fund name that came up in my mind, and that's what I'm going to choose. And then when the page loads, scroll down to the bottom where you will find the fund manager details. It will show the name of the fund manager who are managing this fund and for how long they have been managing it. So here I see this fund manager, Mr. Samir Rach, is managing this fund since Jan 2017 till date. So that's been 7 long years. Long time indeed. You can also expand the information on this to get more details about the fund manager. Now that you have checked the fund manager details, you need to go to another website which is also a very popular website amongst all investors, the Value Research. You punch in the details here and on top select the drop down that shows the number of years. It will tell us the returns it has given for less than 1 year and up to 10 years. Now since the fund manager for this fund has been around for 7 years, let's see what kind of return this fund has given in the last 7 years. Wow, that's a whooping 24.25% CAGR. That's great returns. Mr. Samir Raj is a good boy in class, isn't it? That's how you should view a mutual fund manager. Just in every class, there is a handful of guys who always comes first, second, third. In mutual funds too, you identify those gems. Just in the class, you would always know these are the guys, no matter if he is in class 6 or class 7 or class 8 or class 9, doesn't matter. These are the guys who would top the class always. They are known as the toppers, class toppers. Don't we have? We have mutual fund manager toppers as well. If a guy has done well, he would continue to do well as long as he is there with the fund. That's not a guarantee though, but you can still bet on it, can't we? Can't we say these guys would probably again come first, second or third in the next class where we go? And probably they do. Can we not do the same with the same fund manager? He may or may not perform well, but what are the likely chances for him performing well? The probability of this fund manager giving good returns the coming next 2, 3, 4, 5 years is very, very high. Don't you think so? You should. That gives us a green card. You can bank on his performance. वो भरोसा कि ये बंदा अच्छा काम करता है. That's it. Doesn't it? That's a green card. Number 3, low expense ratio. Low expense ratio gives a particular mutual fund a head start over other funds with higher expense ratios. Differently put, a higher expense ratio is a drag on a mutual fund performance. Let's take two fund houses who run the same type of fund. Let's call them Fund A and Fund B respectively. The returns on them are 10% and 9%. Given this limited information, it seems like Fund A is a better choice. Now the expense ratios for the two funds is 3% and 1% respectively. Now this changes the equation a little bit. The net returns for Fund A and Fund B are now 7% and 8%. Given this information, now Fund B becomes more preferable. So if I go back to the Value Research page here, it shows the returns versus the expense ratios for all popular small cap funds. We see this fund stands second on the list for a 7-year return versus expense ratio. Quant has given the highest returns in the last 7 years and also has been less expensive than Nippon Mutual Fund. So Nippon Mutual Fund comes second in the list on this parameter. So this guy, Mr. Samir Raj, who's managing this fund, has come second in class. Isn't he a good boy? Yes, he is. I can give him a green card, can I? Yes, I can. This is not a recommendation though, right? Number 4, low turnover ratio. A turnover ratio tells you how frequently a fund manager buys and sells the assets in a mutual fund or the securities in a mutual fund. You may wonder, why is that relevant for you? It is important because an actively managed mutual fund would actively buy and sell stocks to maintain or to generate returns in its portfolio versus one that is passively managed. Also, a portfolio or a turnover ratio of 100% does not necessarily mean that all the stocks that this fund is holding has been bought and sold. It only represents the percentage of holding that has changed in this particular year. And moreover, a high turnover ratio means that fund is selling its stocks very frequently. And the more frequently you sell stocks, the more cost you bear on those stocks. The cost of selling those securities, they increase. And when cost increases, it increases the expense ratio. And with that, it affects the returns. So why is this important? Low turnover ratio means it instills the confidence on the fund manager that whatever stocks the fund manager has chosen, he knows for sure that they are going to bounce back. They are going to give good returns for your portfolio. If he's holding on to those stocks, which means he has done his studies thoroughly and is very confident on the possible returns on his portfolio holdings. Low turnover ratio also means it's going to incur less expense on your portfolio. Low turnover ratio also means that the fund is less aggressive. It could also mean it's a passive fund or it's a strategic decision taken. Where do you get the turnover ratio for a fund? You can get it in the value research page. So you go to value research where you already have the fund open, go to other tabs and scroll down at the bottom to find the turnover ratio of a fund. An article from Value Research says, look at this. The successful funds are the ones with turnover ratio of 50% or less. So, in our case, in the case of this mutual fund that we have taken, the turnover ratio is just 25%. That's good. It calls for a green card. Can we? Number 5, the risk levels. Checking for the risk levels are more important than just checking for the returns of a fund. In the world of a mutual fund, risk and returns are just the two sides of the same coin. There is a very important reason. Each scheme discloses its risk potential. The risk is mentioned because that gives the investor the notion of how high risky this particular asset class is, and that would alarm him in putting the amount of money he wants to put in that particular asset class. If you are an investor with low or moderate risk appetite, you can completely ignore high risk investments. That's how SEBI has mandated all the mutual fund AUMs to provide clarity for those investors, for us investors. Moreover, if the fund has a very high risk, it only makes it sensible for us to put our money in if the returns are substantially higher. The risk levels are mentioned right on the front page of Value Research. When you open and search for a fund, it's there right on the top. If you want to be safe, don't choose funds that have a high risk. Find tax efficient funds. Lower taxes means higher returns because you're keeping more of your money with you and paying less in taxes. This could be the only reason why you should stay away from dividend reinvestment funds or bond funds. Alternatively, ELSS tax saving funds can also be good. If your potential returns from an actively managed fund matches with that of an ELSS fund, it's better you go with ELSS funds because that saves a lot on your taxes. Number 7, that's what you have been waiting for a long time. Investing in index funds. See, if you are someone who is afraid of all these finance jargons, who don't understand technical things, or who is not at all interested in learning this money matter and the investing or be involved in the investing journey, but growing money is something which everybody likes, then investing in index funds is the right choice for you. You will not have to validate, scrutinize, or look after anything. You don't have to investigate a fund for its performance. You don't have to check or monitor how a fund is doing, because an index just mimics or copies a particular set of parameters. And if you buy onto the market itself, which is the Sensex or the Nifty, you're actually copying the market as a whole. In that case, there is no need, absolutely no need to analyze a mutual fund and analyze an index mutual fund. All they do is just simply copy over an index and move on. They copy the constituents of an index and move on. And when that happens, all you can do is buy it, set up a SIP, forget it. It will move as the market moves. Isn't that simple? No analysis required, no tensions, no apprehensions. Yes, at times of market crash, you would feel your portfolio has gone down, but again, it will come back when the market bounces back. You cannot charge the fund or the fund manager for non-performance because they simply copy the market. If the market performs, the fund performs, the fund manager performs. If the market doesn't perform, nobody is performing. You are exposed to the market without the worry and the headache of analyzing different funds or stocks and analyzing them painstakingly to choose one best fund for yourself. Number 8, the fund size. Wow, this is a very important factor. The fund in this example that we have taken has a size of over 50,000 crores. 50,000 crores in AUM, that's a massive size for a small cap fund. In spite of its tremendous performance in the last 7 years, this fund has become so huge that it might possibly just start to face some difficulty in placing these 50,000 crores in the sea of small cap funds. That's a large chunk of money to invest in a small identified pool of small cap companies, which is why it makes this fund risky and it may or may not perform very well in the future. So that's a reason which tells us that a fund which has performed very well in the past may not do so well in future, because the limitation of putting in those 50,000 crores into like 20, 30, 40, 50 small cap stocks is tremendous. And just like we know this, the fund managers, the AUMs, they also know it. And that's why as of now, the fund house has stopped lump sum investment on this fund. And they are only and only accepting SIP investments. And that too, there is a limit on a per day SIP, which keeps changing as and when time arises. A time will come possibly when the fund manager or the AUM would find it has become really difficult to put in the sum of money that they have into the small cap industries. They may altogether stop any further investments for any other investor. You may not be able to invest in this fund in future. That's what I personally believe. That's what I personally think. The AUM size has grown so huge that by good faith, the fund manager and the AUM would simply stop any further investments into this fund. That's why we can keep this fund in the watch list. We can still try and monitor it. But here, this fund gets an amber flag. Well, that's it. Hope this will help you identify funds to invest for your future journey. In the next video, however, I will take and break down the first point that I discussed here in this video, how to analyze a fund's performance. I'll break that down to see how in details, how to see and monitor how well or how badly the fund has performed. Don't miss that video for sure. Hit the like button, hit the subscribe button right now. Stay tuned. The video would come up possibly next week. If you're someone who wants to invest in mutual fund or are already invested in mutual fund, this playlist is very, very important for you. You cannot miss any of these items. Go ahead, have a look at it right now. As of this video, adios.